Hey there, my name's Ben Everingham. I'm here with my brother Simon, and we're going to talk about 5 mistakes first-time investors make. So we're going to talk about some of the common stuff like not having a long-term goal. We're also going to get into some of the nitty-gritty stuff like the property fundamentals. So if it's your first time at our YouTube channel or our website, welcome. If you've got any video ideas, we'd love to hear them and we'd love to record them for you. Please subscribe to our channel. So let's kick off today's video with not having a long-term goal and why we both think that's so important for everybody.
So me and you, we're both long-term thinkers, but it's really hard, especially when you're just getting started, if you are younger or a little bit older, to have that long-term outlook towards where you want to be in the future. But it's absolutely crucial to understand where you want to be in the future, and there's obviously, everybody's different. Everybody wants to achieve a different long-term goal. Some people might want to go for a really large equity goal or passive income goal. Some people are just happy with a pretty casual lifestyle. They want to escape and get off the grid and not be a slave to the man for the rest of their life. So writing down what you're achieving right now from a financial perspective, are you happy with that? And then what you want to be doing in the future and how you can either get off the grid or become one of those billionaires.
So as Simon said, there's all sorts of scales here. There's people that, just want to completely disconnect from society. There's people that want to own society. All of us have to make a judgment call of what is going to make us fulfilled and happy in our lives. And so I think it's important to really get a clear sense of, 15, 20 years from now, what the perfect day, what the perfect week, what a perfect year would look like for you. And it's not just about money. Having $100,000 coming in a year without you going to work would be great, but if you had all of that time, what would an ideal day, week, year look like for you? And on the flip side of that, it's important to have that long-term goal, but a long-term goal for me is also a 12-month goal. So what is it that you're actually working towards in the next 12 months? Where do you want to be 12 months from today? How do you want your day, your week, your year to look like? And what would make you feel like you've achieved something over that period of time? So both are equally important in completely different ways. And again, me and Simon, or I'm certainly not about driving Lambos, and maybe I will be one day because things change, but right now it's not. For me, I'm about chilling with my family and about training and surfing and spending time with people I care about and getting to do this epic work that we get to do every day. And for Simon, your goals are a little bit different than mine as well.
Yeah, for sure. I think that's a really important thing, to create that long-term goal and then scale it back into smaller increments, and whether that be a 10, 5, 12-month goal, then bring it back again and go to a quarterly goal, a monthly goal, a weekly goal, a daily goal, and just set those habits and intentions for you to achieve long-term success. There's lots of cool books out there like The 7 Habits of Highly Effective People that you can go out and read to get an understanding of those cool little things that you can do in your life today to put you in a better position in the future.
Yeah, that's a really cool way of looking at it. Sorry to interrupt you, but I'm just thinking there's 2 ways that people plan. I'm very good at planning for the next 12 months and then having an idea of where I'm working towards in the future. But because I change so much, that future end goal changes consistently. Other people, as Simon said, there's a really effective technique which you can use, which is identifying where you want to be and then breaking it up into a series of milestones or steps over the next 12 months to sort of get you going in that direction. So whatever works for you works for you. There's heaps of cool vids on YouTube. There's a really good goal setting workshop by a guy called Jim Rohn that I used to sit down and do each year, and it's sort of a 20-minute way of you not having to think about what you're actually putting down, him facilitating it. He's one of the best business coaches of all time. He was Tony Robbins' boss and mentor for a long time. So that sort of takes us into the second thing, which I wanted to talk about is, unfortunately so many first-time buyers buy really bad property, or they're sold, excuse my French, but completely shit deals by people that pretend they're doing the right thing by them but are actually just making big money behind the scenes. And what I'm talking about there is a lot of first-timers in Sydney, Melbourne and Brisbane are sold brand new product. Now, they're normally sold that brand new product through a company that's looking after them. They could be a financial advisor, they could be their accountant, they could be someone at the bank recommending something, they could be what's called a property marketer, which is an investment company that you don't actually pay anything for, that's going to help you get this amazing property that you find out later on made sort of $30,000 or $50,000 behind the scenes from the builder and the developer. So we don't want to see you get burnt. I've personally lucky enough to have avoided being burnt by a company like that. I have burnt myself though with the properties that I've bought, where I've lost money or bought the wrong sort of stuff. So it's really, really important to have a clear strategy, and to just realize there's nothing wrong with brand new product. But if you're going to go brand new, understand you're going to be getting a small land size. You're probably most of the time going to be sold something further from the city because it's cheaper, or a unit in a ridiculously tall building. All of those products don't perform as well as some other products. And just be aware of that stuff, that you've got to look after your best intentions even as a first timer. And if it means taking an extra couple of months to learn a bit more to make a great decision, then you should definitely take that time rather than rushing into the first company that you talk to or the first glossy magazine that you see. They'll tell you that it's going to perform amazingly well, and they're going to completely overset your expectations in every way. And we just don't want to see you get hurt, or get into a negative equity position, or get into a position where you buy the wrong market at the wrong time and get caught out for 5 or 10 years without getting too much growth. So
there's a few things that you can try to avoid. It comes back to the age-old saying, when something sounds too good to be true, it often is.
100%.
So just be cautious with these things and ask lots of questions. Don't be afraid to ask the hard questions, like how much commission are you making, and actually get an understanding. If they're starting to get a bit hesitant about telling you about where their money is coming from and why they're doing this for free, there might be a little red flag going up.
Yeah, and there's another way to identify it, and that is generally if you walk through the door into one of these investment firms, but they're just called property marketers, and 80% of all brand new property in Australia is sold through these types of companies, and they try and sell you the first product, and they're talking about depreciation and they're talking about cash flow and capital gains, but it's in a area further than 20 to 25 k's from a CBD, then you can almost be certain that something else is going on. And if they're getting upset when you say, well, what other options do you have for me, or they want you to buy their first option, then that's another alarm bell, as Simon sort of said, is to just ask better questions. A lot of them sell great product, but just ask better questions so you don't get hurt. And from talking to over 6,000 first time and very, very successful investors in the last 5 years, we've realized that a lot of the poor performing properties that people have been sold through these networks to people, and we just don't want to see you get burnt by them. So that takes us into the third thing in this video, which is the 5 mistakes made by new investors, and that is not understanding the holding costs associated with the property.
Yeah, so when you invest, obviously there are a number of costs associated with holding that property and making sure it's maintained in the right fashion, and you're taking care of insurance and things like that. So me and Ben actually did a video on this last, a couple of days ago, so you guys can go and check out that to get a little bit deeper about the holding costs associated with investment properties. But just a couple of those things that you need to take into consideration. Number one being the investment repayments, the interest repayments from the banks, another one, property management fees, insurance fees, council rates. There's a number of things that can add up, so making sure that you do a cash flow analysis is really important, so you understand how much rent's going to be coming in every single week and how much it's actually going to cost you to hold that property, because if you're not earning a significant income and you can't afford to have a negatively geared property, by which it takes a bit of money out of your pocket every single week, then you need to understand these costs. And in addition to that, you might want the properties to try and put a little bit of money in your pocket every week and getting a positively geared property. So looking at these options and doing a cash flow analysis on that property. Did you want to talk a little bit more about that?
Yeah, that's a really good point. Like, we say cash flow analysis, but if you're not an Excel person, like I'm pretty analytical now, but I used to do this stuff just literally at the back of an A4 page. So I'd look at a conservative amount of rent. So there's 2 parts to cash flow analysis. There's the money coming in, which is your rent, and the money going out, which is the cost. So, one column, just draw a line down the middle of the page. Incoming rent, it might be $400 a week. You can times that by 50 weeks a year if it's in a good suburb. Gives you about $20,000 per year coming in. Then you might have a $360,000 debt. and you can work out what 5% interest on that is. You might be interest only on your loan, you might be principal and interest, which means you're paying the bank's money back, plus you're also paying off your own home loan. And so you can work out what that figure is as you can talk to the agent and find out what some of those other costs Simon mentioned are, like your management, like your rates, like your water, like your insurances. Generally most properties in most areas lose a little bit of money unless you've got a really big cash deposit in the short term, but obviously the rent increases over time, and if you're a smart investor, you're repaying the debt, or at least putting money towards that in some form or another, to repay the debt over time. So as Simon said, there's also other types of properties like buying a house and building a granny flat that can be cash flow neutral or positive from day one. Again, like, you've just got to figure out what's right for you and how much income you're prepared to pay each week, and just remember that things are historically very stable right now in terms of interest rates being very low. Interest rates, I've paid up to 7.5% interest rates before as an investor in the last 10 years. Just remember that interest rates can increase, which means your holding costs associated with the property can increase too. So don't stress out too hard about it. Do a back of the napkin thing or a back of a page thing. Maybe send it through to your accountant, or just get someone to sanity check it to make sure there's nothing you're missing there as well. That takes us into the fourth thing, which is failing to do the right research. Now, we've done heaps of videos on how to select the right suburb, how to select the right market, how to select the right house, how to find the right property, and how to find properties with great potential. We'll just do a little bit of a summary, I suppose, now. So, what things do we do, I suppose, that makes investing in property a little bit lower risk than a lot of the way that first timers do it?
Well, one thing is we're absolutely obsessed with the data. We're absolutely obsessed with analysing the different markets that are occurring, the global cycle. So that's a passion of ours, and I understand not everybody loves to do that sort of stuff. Nobody knows.
I didn't love to do it when I was getting started, but I love it now.
Yeah, exactly. When you can see the long-term trajectory of it, it makes it a little bit more exciting. But what we like to focus on is, one, identifying the right market. So you can actually get a pretty decent understanding from this from a free source online, which is called the HTW, or Heron Todd White Month in Review, and you can access that via Google. And what these guys do is they look at the entire Australian property market, and they break down each of the major metro markets or the capital cities, and also the regional markets in different states around Australia, and they identify which stage of the property cycle each of those markets are sitting at, and give you a brief little rundown. So that can help you identify a really great market. After you've identified a quality market, which for us, we like to focus on the high quality metro markets, because we understand that the things that drive up or have historically driven up capital growth is strong job growth and strong population growth. So if you look at the major metro markets in Australia, like the Sydneys, like the Melbournes, like the Brisbanes, they've historically had the strongest population and job growth, and according to Michael Matusik, one of the people that we follow, he actually predicts that to continue over the next 10 years in those three markets as well.
Yeah, so what he's saying is 75% of Australia's population and job growth in the next 10 years is going to be split up 25% Sydney, 25% Melbourne, 25% Southeast Queensland / Brisbane. So again, I'm not a gambling man, but if I was rolling the dice, I would be rolling it towards where 75% of the future value and income is going to be, and not trying to, predict the future outside of that. So, once you've identified the right market, Simon, how do you sort of go about reducing it to that suburb level? Because, Sydney, for example, is an area of 200 odd suburbs, you know what I mean?
Yeah, so a rule of thumb that is really good to keep in mind is buy as close to the CBD that you can afford, or as close to the beaches that you can afford. So if you look at the historical performances, the closer that you are to the centre of the CBD, the better it's performed than the outer suburbs. So for us, focusing within that 25 kilometre radius of the CBD, or within walking distance to the beaches, because that's what the owner occupiers want, that's what the young families, young professionals want, and that's what's historically performed the best also.
Yeah, and so some of the other little tips in terms of doing the right research that we've found is obviously you time the right market using that Herenthold White report plus some other things as you become more sophisticated. Then you find the right suburb, which historically has been closer to the city or on the beach, close to the city. We know from the data from CoreLogic that houses have historically outperformed units as well. There's some of the basics in terms of really understanding what type of product you should be targeting. Then, looking at the right piece of land and the biggest, potential piece of land that you can afford in a nice quiet street that you, if you're in that raising a family stage of life, would like to live in, as opposed to being on a busy road and all of those other things. So come back and check out some of our other videos, because there's a lot of data points that you can start looking at that you can find online relatively easily for free, and start interpreting as well. There's another really cool little free source which I think you can get off yourinvestmentpropertymagazine.com.au, and that is the DSR score, which is the demand to supply ratio score. Again, there's no silver bullets in property. You have to take everything as a grain of salt, but the DSR score looks at the demand in relation to the supply in a particular suburb at a particular time. There's bands that you can read about online about when is a good time to buy a suburb, when it's heating up, and when is a good time to exit a suburb if you're thinking of selling. So that can be really useful for a first timer as well in terms of getting a sense of one suburb versus another.
Yeah, in addition to that, if you wanted to call up a professional and have a free consultation, and maybe they can point you in the right direction as to what avenues you should be looking towards, taking into consideration your financial situation, your long-term goals also.
Yeah, for sure. So the fifth and last thing we wanted to touch on is just not understanding property market fundamentals. And this is stuff that's taken me a long time, pretty much 9 or 10 years now, to really wrap my head around. And it's going to be a forever learning process because, at the end of the day, the property market, the global economy is such a complicated beast that, you can non-stop get different opinions. Like ours is one opinion based on our research, and everybody else has got a different opinion. Your job is to collect those opinions and then decide what's best for you based on your own strategy. But some of the fundamentals we already mentioned, like buying your Sydney, your Melbourne and your Brisbanes, targeting houses over units, targeting big land, buying as close to the beach as possible, buying in suburbs with train stations, buying in suburbs with good school districts. These are fundamentals that have worked time and time again for hundreds of years in Australia and America and Europe, and they're the things that are going to continue to keep growing. So another fundamental from our perspective is timing. Think about it, it's 2018 now. How much better off would you have been if you could have bought a property in Sydney in sort of 2012 or Melbourne and ridden that growth over that period of time? Or how great would it be if each time you bought property you could relatively time the market and the area that you're buying so that you're maximizing that capital growth and your rent return, or you're buying something with potential to add some value to. So there's lots of different ideas about this stuff online. Timing is very important. Some of those other rules around houses close to the city, close to the beach, big land size, good quality owner-occupier suburbs. Another fundamental for me as an investor that's very important is cash flow. So I love to buy properties with like a house that I can add a granny flat to, or a piece of land that I can build a house and a granny flat on. We've recorded another video called 2 Properties to Financial Freedom, which I think would be a really nice starting point if you're just getting started as a first-time investor. Whether you own your own home or you're just buying your first property in general, that's a really nice way that you can sort of look at where you are now and how you could work towards financial freedom without buying 10 or 20 properties like all of the spruik online, just simply by buying 2 houses, adding 2 granny flats on them and going from there. So just to wrap it up, today we've talked about the 5 mistakes first-time buyers make. We talked about no long-term goal, buying rubbishy property or shit property as I called it, not understanding the holding costs associated with the properties,
failure to do the right research.
Yeah, sorry, I lost my train of thought there.
And not understanding the fundamentals of property investing.
So that's us. If you're interested in talking more, we would love to offer you a one-on-one strategy session. You can just jump over to www.pumpedonproperty.com and click a free strategy session, which will be either with Simon or myself. They're more for people that are seriously considering buying a property in the next 3 to 12 months, for people that have employment and obviously have some money in the bank. And that's just a complimentary session. We're not going to try and sell you anything, where you can look at where you are right now and where you want to be in 12 months from today, as well as the future, what's holding you back, and take advantage of the insight that we have from buying over $200 million worth of property for our clients and ourselves. So until next time, we really appreciate your time and attention, and please subscribe. See ya.
Bye.